Welcome to the Real Estate Explainer podcast, where we talk about anything and everything real estate. I'm your host, Brian Kiczula. Welcome back to another episode of the Real Estate Explainer podcast. I am your host, Brian Kiczula, a cost segregation specialist with Cost Seg RX. Today, we've got Marty Remillard on the podcast, and we're going to be talking about predatory lending in Florida. Let's jump right into the episode. Marty, if you could go ahead and introduce yourself.
Yeah, so my name is Marty Remillard. I'm currently a licensed realtor, a licensed mortgage broker in Florida. I've been doing construction, mortgages, and real estate. I have over 34 years experience doing this, and I was Florida Association of Mortgage Professionals Broker of the Year in 2015 for the state of Florida, so my background is pretty extensive. But what I want to talk about is the HEI, or the HEA, home equity investment or home equity agreement, depending on which lender is putting out the product in different ways. And there's a lot of brokers out there that don't understand this product and really how it works. And right now we brought quite a few files to the state of Florida. They're investigating it. When I say the state of Florida, Florida Office of Financial Regulation. So they're looking into it. I have one of the top compliance attorneys working with me on this. And we believe, to the best of our knowledge, that this is just a big case of fraud out there.
And basically stripping the equity out of properties.
Yeah. And they disguise it as they're investing it in you. So the trap is you need money to fix up your home, whatever you need money for, use the equity, don't go and get a loan. But we see it in the way we presented it to the Florida Office of Financial Regulation is that it is a loan. And what they did is the lender is trying to bypass the SAFE Act, which protects consumers. So it's a big issue. We think it's theft. It's just our opinion at this point without a judgment and a complete, thorough investigation by the Florida OFR.
I know home equity lines of credit, home equity loans. So a home equity investment or a home equity agreement, let's say that you're a broker pitching this to a client. How would you sell it to them? What is the product?
I'll read it just as the advertisement that this one particular company sent out. It said, break free from monthly payments. You have no monthly payments. Basically, it works similar to a home equity line of credit. We're going to give you money based on the equity that you may have on your home. And there's no payments. Term length is 30 years. Monthly payment, 0. So they project this as we're investing in you, and you can do what you want with the money, and we'll just attach a lien to the property. And that's basically simply how it's sold. Relax. There's no payments. There's maximum flexibility on your house, no prepayment penalties, nothing. And when you sell or refinance out your home, we just take the money we gave you or our share of it back. And they make it that simple, that easy. And you can see it, that there's 30 years, no monthly payments.
Yeah, and I'm looking for your interest rate on this.
There's no interest. That's what they tell them. So I went through this with the compliance attorney, and we worked on it together. I found this. I stumbled on it by accident, where someone called me up and they said, hey, I'm having trouble with my house. And the lender, it was after a hurricane, they're not releasing the funds for me to repair my house. So I said, let me come over, bring out all your paperwork. So I looked at it. I just looked at the first 2 pages and I was shocked. I said, whoa, I need time to digest this. So let me take all your paperwork with me back to my office and I'll go through it. It was someone we knew, old previous friends. So my wife came with me. We got in the car after we left, after some small talk and stuff. My wife says, I never seen you like that. I said, this is fraud. And she goes, you only looked at 2 pages. I said, yeah, I didn't want to get into it and having her ask me a lot of questions. I really want to go through it. So a couple days later, I got into it. I got to page 5 and I had to throw the stuff on the floor. And I said, this is just nasty. So I waited a couple more days when I could really spend uninterrupted time. And it was about 80 pages, this thing. And I read every one and I started making marks on the paperwork. And I called the attorney. I got a message into him. He texted me back, said, send me an email of what you think it is. I sent him a bullet point email and he immediately picked up the phone and called me, and it was a Saturday morning. And he says, this is fraud. This hasn't been around for over 30 years. This goes back to the 80s when lenders tried to pull this crap on people. So we got into it and spent a lot of time, and we really broke it down good. So he wanted my opinion on it, and I came up with 28 felony accounts on the first file. And then he said I did a good job, and he came back, he said, but you missed 2 felonies.
Wow.
So I was like, oh, this is crazy. So in essence, they tell you there's no interest being charged, but that's false. There's so many traps they do with it. So I'll just give you the bullet point on this one. What was not performed by the lender nor the originator. So the first couple files I found, the lender wasn't even licensed in the state of Florida. On all the files I found, no loan originator for that company was ever licensed in the state of Florida. The first thing is ATR was never met or factored in any credit, and credit was never pulled on the client. There was never a formal application, a 1003 taken for the client. They sell it as a HELOC, but they tell the client it works like a reverse mortgage, but it's a bait and switch on the home equity investment option agreement is what they call it, but it's recorded as a mortgage.
Okay.
So once you record a mortgage, you're basically calling it what it is. It's a loan. Not licensed in Florida, I just talked about that. The investor lender immediately sells off the mortgage to another non-licensed investor lender. So we're looking at money laundering here. We're seeing a lot of them, the back-end investor are Chinese nationals or foreign nationals that they're getting the money from. So it's a way to launder money into the U.S. and grab real estate, because this whole thing is a bad trap. And it doesn't go 30 years. These things self-destruct. Between 5 to 7 years, mathematically, they self-destruct. So the people losing their home, they're forced to sell.
So that's what I'm wondering. Is it an equity play on the property then?
Yes. It's real bad. They give them money up front and they tell them it's an investment in them, which is a problem. All the homes have been primary residents that we found, and they also target people over age 60. So Florida has a law to protect our senior citizens, right? They have a couple laws out there protecting our senior citizens. But over 80% of the clients that we gathered for this, they were single women over age 62, and they took advantage of them not knowing. So the other thing is, in RESPA, the consumer has the right to pick their closing company or closing attorney to represent them. But these lenders bypass that by saying, we're going to pay your closing costs. But they have fees. They have their processing fee of over $3,000, but their closing costs for these and the title insurance is less than $1,500. So they're overcharging over here to use that to pay. So the lender actually never brings money to the table other than the money that gets funded, and they subtract all the closing costs from the money they're giving to the people. So it's a play, and it's a hidden shell game of how the money's used. So the consumer never really has their choice. And they always pick a title company or a closing attorney that's such a great distance from the consumer, usually over a 2-hour drive, that they can't go to them. So they send a notary out to their house to sign all the documents. There's no loan estimate. There's no closing disclosure. They hide it with different names. They change all the names on the document. So they don't have loan amount. They have investment amount. So basically, it's like changing the pronouns on everything.
So the home equity investment or the home equity agreement, it got no interest due. How does it blow up after 5 to 7 years?
They say it's a cap on the investment that they're getting. Okay. So in the one I have up in front of me, it says the option agreement is 57.7% of the equity filed as a mortgage. They keep calling it a closing disclosure that they put out. They'll have option investment payment. So the lender is going to give them a payment, which is actually a loan, but they change it. Then it says appraised value of the property, then original agreed value, which is reduced from that. And then the option term is 30 years. Option percentage is 57% in this case. And acknowledgement of pre-existing loans. There was a first mortgage on this house. And then point proceeds cap factor, they have 16.5%. But when you read it, it says option investment payment. They're giving the client $58,000. This is the amount Point will pay you to purchase the option in your home. So they're always calling it an option. Now, back in 1974, there was an action in Florida that said you can't record an option in the state of Florida in the county records. So it's an option to purchase a certain portion of equity of the home. That's how they sell it, but it's against Florida law to record an option. So in order to attach a lien to the house, they file it as a mortgage. Once they file it as a mortgage, basically they're calling it a loan because they're filing a mortgage. So now they do appraised value, which they charge the people $500 to $600 for an appraisal. But all as they do, and they show you on a sheet, they give the people a copy of the sheet. They go on a Zillow and they say, oh, what's Zillow think the property's worth? And they pull that number up and they put it on their spreadsheet. And they tell you information came from Zillow or Redfin. And they put it out there. And they call that an appraisal after they just charge a consumer $500 for an appraisal. And it's not an actual appraisal.
I'd like to thank today's sponsor, Cost Seg RX, a cost segregation company. If you're interested in getting a cost segregation study, or if you'd like a free estimate of benefit, log on to realestateexplainer.com and click the cost segregation link at the top of the page.
So it's not even a clear record. And then they say original agreed value. Now, in this case, they said it was $260,000. They put the agreed value as $221,000. So basically $39,000 less than the Redfin estimated value. So also called the appreciation starting point. Okay. Not appreciation from the $260,000, but appreciation from $221,000. Now you go down a little further and it says option percentage. They're going to take 57.7% of the capital gain. And the capital gain, we go back up, is from the $221,000, not the $260,000 of future value. So the option is either they're taking a portion of the capital gain or the cap factor, the points proceeds cap factor. Now, this is interesting. The point protection cap, they call it. This factor is used to calculate which limits what you will pay the lender when the property sells or at the end of the term. And it's 16.5%. That's the cap factor.
Is that an annual cap factor?
You would think so, but it compounds monthly. So you have to get into the big option agreement, which is about 37 pages in itself. And there's a little paragraph in there, and it says it's factored annually, but compounded monthly. So when you run that factor out on $58,000 that they're giving you, which they subtract the closing costs from, which usually runs around $6,000 on $58,000. So you're paying compound interest compounded monthly. And then in the option, the lender says they'll take the lesser. But the ones that have already sold, or the people were forced to sell and the lender took over the house at year 5 or year 6, the people, they were just paid $10,000 to walk away from the house. So they lost all their equity.
So essentially what's going on, they're going to give you the $58,000 so you could put on a roof and fix up your home, do whatever you need to do to stay on the property. They're not charging you an interest rate or a monthly payment like a loan. So that sounds great to a borrower. But once you read the paperwork, the disadvantage, it's an equity grab. So once you go to sell the property, you have to repay the $58,000 that they gave you, plus 57.7% of the equity of your property, or the 16.5 cap factor.
Almost. So of the $58,000, they're going to get their principal back, and then the lender takes their choice. They say the smaller, but they've always taken the larger when people have to close out on this, which would be the interest rate, because we're in a declining market in Florida. So they don't want to take the capital gain, which would be 57.7% of the capital gain. But the capital gain is not based on the appraised value of $260,000. They reduced it to the agreed value of $221,000. So their gain of that 57.7% based on that spread between the refinance amount, appraised value, or the sale amount. So say the people sell the house for $300,000 and the original appraised value was $260,000. That's a $40,000 difference. They're not taking 57% of that $40,000. They're taking 57% that's above the $221,000, which is $79,000. So they're taking 57% of your capital gain plus their $58,000. So you have no money left. They took it all.
Yeah, it's one of those things that if my mom called me and said, hey, I've got this great opportunity to get $58,000 or $100,000 or whatever it is to fix up the property, or it doesn't need to be tied back to the property. And I think that's something that we have to look out for as well, is it could be someone else needs their money to purchase a car or go on a vacation, because unfortunately, sometimes seniors have grifters in their life that just won't go away. And this is a way for them to tap into their home equity.
Yeah. So the lender has an option to take the capital gain grab or the percentage of their cap factor. It's actually a monthly compounding interest rate. In this case, is one of the lower ones at 16.5%. I've seen them as high as 21% on their home. And that's compounded monthly. And the option is the lender can call that at any time with a 15-day notice in their contract.
Is it based on a loan to value, like the loan to value dropped, like a margin call almost?
Yeah, when the equity runs out in a house, because in a reverse mortgage, you basically have negative equity because the interest rate that you're paying on the loan that you took out on the house, it compounds and it grows. But you're protected by FHA, right? That house is protected. So even if you go negative, they don't kick you out of your house. You live there till you die. Most of them are based on age 92 or 102, whatever the mortality table they're using at that time. In your age, they calculate how much they can give you. Here, they're not doing that. They just taking a guesstimate of what your home is, lend you so much money, and then they compound it. The interest that you owe on that $58,000 they gave you, when that exceeds and you have no more equity, they call that no, because they're not getting any more money on their investment. So that's why I said at the beginning, these expire in 5 to 7 years, depending on many factors, such as, is it a declining market or appreciating market, what the interest rate is, what your first mortgage is, if you have a first mortgage. So they have that option for a quick grab to get out. So their investors know it's a long-term note, but it's only a 5 to 7 year note. It is not a 30-year program.
Playing the devil's advocate here, is there any situation where this would be a good loan for a borrower to get into?
Absolutely not. It's the worst thing in the world. There's nothing. It's designed to pull the equity out of your home, and at your expense, at your demise, you will lose your home.
And if you're seeing this here in Florida, you know, it's going on in other states. It's just flying below the radar right now. So I'd definitely say if you have any seniors in your life, definitely pay attention to these types of loans that are out there. Really keep your eyes open if you're active in the real estate space.
Yeah, these are definitely designed to self-destruct and strip the equity of these consumers' homes. And especially they target single women over age 60.
I can also see this translating into commercial lending as well. Small commercial lending for individuals that own, let's call it a small retail strip center that have a lot of equity, but don't really have any options when it comes to financing for various reasons. So just predatory lending in general is something to pay attention to.
Yeah, it's a tough one. They target the people, they tell them they're investing in them, in their home, but it's not an investment. It is a devastating mortgage trap.
We talked about reverse mortgages real quick. We're specifically talking about a product right now called Home Equity Investment, HEI, or Home Equity Agreement, HEA. How would someone protect themselves if they found themselves working with a broker that offered this to them? I do recommend getting a couple of opinions. So my advice would be to run it by another mortgage broker, another loan officer, get their take on it. What do you recommend for someone to protect themselves?
Always hire a real estate attorney. You're talking about the largest investment of your life, your home, and it's your dwelling. So I would have a good real estate attorney review your paperwork before you sign anything and have the closing at their office. Because the consumer here in these cases never see the documents they're signing until that notary shows up at their house. It's designed so they can't ask questions because a notary can't ask legal questions. They're not licensed in mortgages. They're not licensed in real estate. They're only verifying your signature, so they can't answer the questions.
That's a good point. I think having a good real estate attorney or closing office that is a neutral third party or a party that you specifically hired to review the documents is great advice.
Yeah, it's really important for the consumer to understand when you have a title company do your closing, the title company has a fiduciary responsibility for the transaction. They don't represent the lender and they don't represent you, the consumer. When you hire a real estate attorney, they now represent you because you're paying them. Don't surrender that ability just because the lender offers to pay your closing costs or your title insurance. Don't surrender that. It's not worth it. You're talking maybe $800 to $1,500 for a closing attorney to review your documents. I would strongly recommend you use a good real estate attorney, especially on these traps.
Thank you for the information, Marty. I certainly appreciate jumping on the podcast today. I know you are no longer actively doing loans. If anybody wants to get in touch with you, what's the best way for them to reach out to you?
Email me at martyremillard@gmail.com or my phone number, 941-223-9416. I return all calls within 24 hours and I return all emails within 24 hours. So I will get back to you.
Awesome. Thank you for jumping on today. If you'd like to get connected with today's guest, log on to realestateexplainer.com and click the Get Connected button on the homepage.